You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. And today, before we begin, I want to remind you, as usual, that there's a website associated with this podcast called wealthformula.com. And on that particular website is a way to sign up for our Accredited Investor Club. Now, Accredited Investor Club is for people who qualify financially to be considered accredited investors, basically making $200,000 per year for a couple of years with the reasonable expectation to do so in the future, $300,000 if you are filing jointly, and a net worth of $1 million or more outside of your personal residence. Could be either one of those. That means you're an accredited investor if one of those criteria is met. And that means you can sign up for our particular group. And you should consider this right now if you are interested in potentially taking advantage of one of the very unique periods in time that we've been in. Let me explain that. I have interviewed a gentleman in the past, episode 423 actually, Campbell Harvey, and I've referred to him multiple times. I think he's a really smart guy and he's really onto something. He is at Duke. He was the economist that first described the predictive value of the inverted yield curve. This is a LinkedIn post that I'm going to read to you because I think it's really valuable. He writes, "It has begun. Over the last year, I have made the strongest possible case for the Fed to be proactive. Rates should have been cut this week. Indeed, rates should have been cut in January. We have seen this movie before. The Fed was very late to take inflation seriously in 2021. They brushed it off as transitory. However, it seemed obvious that inflation was surging. Real-time shelter inflation was increasing at a double-digit rate. Shelter has the largest weight in the CPI. CPI is, of course, the marker that's used to measure inflation." He goes on to say, "Shelter operates with a lag," meaning lag time. "Hence, it was easy to forecast the surge. The Fed was forced to react after the damage was done." Okay, so now he goes on to say, "The same mistake has been repeated despite many warnings. The recent CPI print was 3% year over year. Nearly 2/3 of this print was driven by one component, shelter. Shelter inflation is reported at 5.2% year over year. And what he's saying there is that's what they use to get to the 3% CPI number. He goes on, "This number is far from reality. For example, apartmentlist.com rents are running at negative 0.8% year over year, a full 6% below the official CPI number. Suppose we believe that real-time and shelter inflation is even 2%, not 5.2%. This means the real-time CPI would be 1.8%. And if you believe shelter is 3%, then real-time CPI would be 2.2%. Both of these numbers are well within the Fed's target." Now, notice he isn't even using the negative year-over-year growth, which, I think it's probably closer to zero than it is even 2 or 3% across the country. Okay, next, goes on to say, "The Fed prides itself on making data-driven decisions. However, it is unwise to make decisions based on stale data. The shelter inflation happened in the past. Keeping rates high will not impact what happened last year. It is always best to look at forward-looking indicators for policy decisions. My yield curve indicator has been inverted for 20 months. It is 8 out of 8 with no false signals since the 1960s. The maximum historic lead time has been 23 months. Ignore at your own risk. The SAM rule, SAHM, has been triggered. This indicator is not necessarily predictive because employment moves with the business cycle, but it is useful in telling us whether we are in a recession or not. We know that hiring is slowed and unemployment has risen, though the absolute rate is still relatively low. Retail sales are highly correlated with personal consumption expenditures. Retail sales are flat. Many do not realize that retail sales are not inflation adjusted. Taking inflation into account, recent sales growth as well as year-over-year sales are actually negative. There is considerable evidence that the COVID-era savings have been drawn down. A recent release from the Philadelphia Fed carried the headline, "Share of delinquent credit card balances reaches series high." The same report shows an alarming plunge in mortgage originations, by the way. People are paying 20% plus interest on credit cards because their savings have run out. If people are cutting back on fast food expenditures, you know this is serious. Drawing down the savings has fueled consumption expenditures over the past 2 years. The source of growth has ended. Now the Fed will have to play catch up and cut by at least 50 basis points in September. Any recession at this point is self-inflicted wound. Okay, hopefully you followed that. I've been talking about the same thing here now for a couple of months, and I really am looking at this and like, wow, it's really happening, right? I mean, all the other parts of the economy are starting to slow too, on top of this lagging indicator, which we know is going to show up pretty soon, is like right around zero. So for real estate investors, this scenario presents a compelling call to action, in my view. Now, this is Buck Joffrey speaking, not Campbell Harvey anymore. So there's something called the SOFR, right? The Secured Overnight Financing Rate. It's a benchmark used in many adjustable rate mortgages, intrinsically linked to the Fed funds rate. Basically, anything related to apartment buildings when you're buying it's going to be linked to SOFR. And as Harvey predicts, imminent rate cuts by the Fed will likely see a corresponding decrease in SOFR, because SOFR, unlike the 10-year Treasury, does not move sort of in real time. So this creates a unique window of opportunity in apartment buildings where we are, where debt is linked to SOFR. Okay, so consider this. If a real estate investment makes financial sense in today's high-interest environment, imagine its potential in a future with lower rates. As the Fed lowers rates, we can see SOFR going down as well. Moreover, declining interest rates typically lead to increased asset values, including real estate. Again, that means that if you're in a declining interest rate environment, that is basically the wind at your back in terms of potential appreciation, even from things that you're not doing, like driving up net operating income. The situation we're in has a striking resemblance to periods of previous rate cutting cycles. And historically, those people who moved in such environments reap significant rewards. So, the current climate right now, similar opportunity for forward-thinking investors. And it's worth mentioning again, this is really a rare confluence of circumstances. The Fed is pretty much guaranteed it's going to decrease rates, and SOFR will follow suit. But SOFR won't move until they say. So this means that investors who enter the market now are positioning themselves at the starting line of what could be a significant upswing in real estate values. And I will add to that, I think not only from the rates coming down and adding to the asset value itself, but also creating more froth in the market. Bottom line is, good time to buy. If you're an investor club, good for you. There's live opportunity there right now. You can take advantage of it. If you're not, get in and start taking advantage of this window. Again, it's like everybody wants to invest when there's like a tremendous amount of froth out there already, but this is where money is made. So anyway, this week's podcast actually is talking about inflation. Specifically, my guest has written a book on how inflation actually shapes democracy, and we'll have that interview right after these messages. Welcome back to the show, everyone. And today, my guest on Wealth Formula Podcast is Carola Binder. She is with the University of Texas Civic Leadership Group, previously the department chair in economics at Haverford College, a NBER research associate in monetary economics, a non-resident fellow at the Brookings Institution, and a senior affiliate scholar at the Mercatus Center. She's also a member of the editorial board for the American Economic Review and an associate editor for the Review of Economics and Statistics and the Journal of Money, Credit, and Banking, and the author of Shock Values, Prices and Inflation in American Democracy. Carola, welcome to the program.
Thanks a lot for having me.
Yeah, so Before we get into sort of the topics of the book, I'm just curious. We're kind of in a unusual spot right now. Just your comments in terms of the way inflation seems to be kind of slowing down here, and what your take on it is.
Yeah, I think we're making progress on the inflation front as far as inflation coming back to its 2% target. The 2% target, remember, is not for the CPI, which is the Consumer Price Index measure of inflation that gets reported so much. The Fed's 2% target is for PCE, which runs about half a percentage point lower than CPI. So what they're really shooting for is CPI coming in towards 2.5, and I think we are making progress. There's been some market turmoil in the last couple days having to do with the labor market. So there's still a lot of uncertainty about the Fed's next moves and about how well the economy is tolerating all the monetary tightening we've had over recent months. But I think that on the inflation front, things are looking, I'm optimistic.
Yeah, I'm curious in your take on this too. Just as a follow up to this, I had a gentleman on the show who is Campbell Harvey over at Duke a while ago, and he was talking about how one of the lagging indicators in both the CPI and PCE are housing, and how right now those numbers are hugely different from what they're actually using in those equations, and that he believes that, if you put the real-time numbers in there, inflation would be under 2% by any measure. Just curious on your take on that.
Yeah, I mean, I'm not an expert on housing, so I would trust Campbell Harvey more, but I think that, that sounds plausible. Housing is notoriously one of the most difficult pieces of the price index to measure. There's a lot of reliance on imputation because most people aren't, most houses are not being bought and sold every month. So there's a lot of trying to impute those values, and depending on different assumptions, you can get different estimates of how house prices are moving. Yeah, so it's possible that the actual numbers are misstating things if we're not, capturing those house price movements accurately.
Right. Well, let's move to sort of the topic of your book, which is Shock Value Prices and Inflation in American Democracy. So how would you say that inflation and politics are intertwined?
Well, they are very closely intertwined, and they always have been. And that's because of the way inflation affects different people in different ways, and it affects different interest groups in different ways. So one of the kind of more obvious ones, and one of the big ways, is its effects on debtors versus creditors. So most debts are made in nominal terms. So you might, take out a loan and you agree you're going to pay $100 back in a year, and that doesn't depend on what inflation is. So if you are the debtor, you're actually going to be helped by higher than expected inflation because it'll reduce the real value of your debt. And if you're a creditor, it's just the opposite.
Right.
So earlier in U.S. history, when a lot of the country was farmers, and they would tend to take out debt in order to pay for the things that they needed, right? And they would be able to pay that back later after their crops are harvested. They tended to push for policies that would lead to higher inflation because deflation was really harmful to them as debtors. So that, immediately starts this politics around inflation. And there are other ways too that inflation affects different groups of people in different ways. For example, if you're on a fixed income, if you're a retiree, then you're going to be more, sensitive to inflation, or just depending on what kinds of items you buy, you might be more affected by inflation. It's also like, what are the actual policies that are responsible for the inflation? Those are also things that affect different people in different ways, like the different kinds of fiscal policies and regulatory policies. So it's all very surrounded in politics.
Right. How do you explain the fact, when you think about that, Americans mostly vote to favor policies that support inflation? Again, is that, they're not, obviously most Americans are probably not thinking in terms of the terms that you mentioned in terms of debtors generally are benefiting from inflation.
Right. So yeah, it's not like in the election of 1896 when William Jennings Bryan was running on, let's have more inflation to help the
Right.
farmers, and people were deliberately trying to vote for more inflation. Nowadays, I think it's more of people like the kinds of policies that have inflation as a consequence, and they might not even see that connection. And there's also these different time horizons where people might like, say, a fiscal stimulus that in the long run might be inflationary, but they're not connecting those two. It can also be the politicians themselves who have a shorter time horizon. If a politician is trying to get reelected, they're going to be in favor of more expansionary policies that boost the labor market, that give people more income to spend in the short run. In the long run, that might lead to more inflation, but that's not the time horizon that a politician would be concerned about. So it's that mismatch.
How has the U.S. government historically controlled prices? Has that been primarily through sort of, well, it's not really government, but the Fed, or how has the U.S. government in particular necessarily been involved with controlling that?
Yeah, so my book actually starts before the Revolutionary War, so it goes through this whole sweep of American history. The Fed only was created with the Federal Reserve Act of 1913, so it's only relatively recently that we've even had the Federal Reserve, and even more recently that the Fed has had price stability as its mandate. For a lot of U.S. history, the U.S. was either on the gold standard or a bimetallic standard, meaning gold and silver, and that sort of it has some stabilizing properties built in. It constrains what monetary policymakers can do. And it means that over long periods of time, you're going to have relatively stable prices. Although over shorter periods of time, when there's maybe gold discoveries or greater demand for gold in other countries, you can have price fluctuations. So there were a lot of episodes, especially during and after wars, when maybe the U.S. Temporarily left the gold standard. We had a wartime inflation and a post-war deflation, and there were different interest groups pushing for the government to kind of do something about these price fluctuations. Often it was various types of tariffs, fiscal policies, and regulatory policies, including price controls that
Yeah.
have been attempted.
So, how do price controls impact the economy? Like, who wins, who loses? I know, thinking back, I think there was some during the Nixon administration. Just curious on your take on that.
Yeah, so price controls, what they're doing is they're saying, okay, instead of the price mechanism being determining prices and kind of so in normal times, yeah, we have market determined prices, and those are determined through like the balance of supply and demand, and they give good signals about what people want to consume and what needs to be produced. But then mostly during extreme time periods like wars, we've used price controls, and these um, controls, you asked about winners and losers. Well, they work well when we're not thinking about winners and losers within our country, but when we're thinking about a shared goal, like our goal is to win World War II. If you have a situation like that, then people can kind of get behind the idea that, well, maybe we do need to sort of ration our resources and make sure that they can be directed towards the war effort. People are kind of more willing to suffer through some scarcity, some shortages of what they might normally want because they have this shared goal of getting, of winning the war. In normal times, the kinds of scarcity and rationing that price controls are going to cause is not going to be politically acceptable to people. They can certainly have winners in particular industries. So that's why whenever there was price controls being implemented, there was tons of lobbying from industries to Congress to say, basically to argue for why they needed exceptions to the controls, why certain prices should be higher or lower than they were already set, because of the different kinds of advantages you can get that way.
Let's take maybe a more an example that more of our listeners. We have a lot of real estate investors on this show. How does rent control ultimately impact the economy? I mean, I know obviously the intention is to make it more affordable for people, make it easier to affordable housing, but what's the net result at the macro level of that?
Yeah, so if you have rent controls, and again, you're not really letting market forces determine how much of the good, which is in this case the housing service, is going to be provided. You'll end up with shortages. You'll end up with the owners of the housing. They might invest less in making improvements to the housing units if they're not able to charge market rent for them. You would end up with a deterioration in the quality of those units. Often these kinds of controls have unintended consequences like that. I'm not sure about the macroeconomic impacts, say on inflation, on unemployment, but I mean my instinct is that they're going to be negative, right? You're kind of preventing the most efficient allocation of goods and services, and you're reducing the ability of people to live where they need to live in order to get the kinds of jobs they want. So I think it's just reducing the efficiency in the economy and having pretty negative consequences.
How do price controls and, say, Fed control differ?
Yeah. So this is interesting because the Fed, when they were talking about having price stability as a mandate in some of these early conversations in Congress about whether the Fed should have a price stability mandate, they were worried that people would have that sort of confusion. They would hear that the Fed is, responsible for price stability and think that the Fed was price fixing or basically implementing price controls. The Fed does not do something like price controls. Price controls affect relative prices. So a price control would say, okay, milk must be $3 a gallon, or rent can only be this amount, and it affects the relative price of milk relative to other things. The Fed is not supposed to be at all concerned with relative prices, just with aggregate prices, just with overall inflation. So they are using their monetary policy tools to basically expand or contract aggregate demand, which would increase or decrease overall inflation, but they don't have any ability or any desire to say fix the price of gas or the price of milk or eggs or any one particular good like that. So then it's market forces that are controlling those relative prices based on relative demand and supply.
So, how independent is the Fed necessarily from the government?
Yeah, it's a really kind of a tricky question because independence can mean different things. And there are economists who try to make measures of how independent different central banks are. And it's a really multidimensional concept because there's, how independent are they in different laws and in practice, and how much of a role can the president or can Congress play in appointments and firing. But the Fed is relatively independent, I think both de facto and de jure. So there are laws protecting the Fed's independence in various ways, like members of the FOMC have pretty long term lengths, and it's pretty hard to fire them. So Congress has given the Fed its dual mandate for price stability and maximum sustainable employment, but they haven't told the Fed how to define those. So the Fed has independence in even interpreting what price stability means. It wasn't Congress or the president who said price stability means 2% PCE inflation. That was the Fed. And the Fed also has independence in how it thinks it's best to get to that goal. But there's always the ability of the government to exert different kinds of political pressure on the central bank. And some of it is good, right? The Fed needs to be held accountable. It's accountable to Congress. So Congress does have oversight. The Fed does have to give these semi-annual reports to Congress. They've become more transparent in recent decades, and that's kind of one of the conditions of their independence is they have to be accountable to the public so that even though they're independent and we don't vote on or elect Fed officials and we don't vote on monetary policy, they have to still have that democratic legitimacy.
One last question I have for you in terms of, just thinking back to the idea that, inflation ultimately rewards debtors. What impact does that have, like when the government's perspective of inflation, obviously, because there's a lot of debt within the government, right? A lot of sovereign debt. And so if you were in a deflationary environment, you would actually, you would be harder to pay that debt off.
Yeah, it depends on like what currency the debt is owed in. So countries have tried to inflate away their debts before.
Yeah.
But it's not totally straightforward because like in the US, like we couldn't really just inflate away our debt very easily. The Fed, as a result of the high inflation, had to raise interest rates, and those higher interest rates increase the cost of that debt.
Right.
So I don't think that it's necessarily that helpful. In like, if we assume that we're going to be returning to the 2% inflation target, then higher inflation means the need for higher interest rates, which increase that debt burden cost.
Am I missing any important points that you would think are useful for us from your book? I mean, obviously, it's an entire book, but I want to make sure we hit some of the key points. Are we missing anything in particular?
A key point that I make is about the need for transparency to allow the public to kind of know what exactly the Fed's goals are. And the Fed has made a lot of progress towards being more transparent, but I think that there's still not a great amount of transparency as far as knowing how the Fed is going to be data dependent. They claim to be data dependent, but we still don't know exactly how, say, if the next unemployment report comes in a little higher than expected, what is that going to mean for what the Fed's going to do? And that leaves a lot of uncertainty, and it makes it harder for markets and for the public to know what to expect and to know how to hold the Fed accountable. So I think that's something that when the Fed has its upcoming framework review, hopefully they're going to be talking about is that transparency, that issue of how to communicate with the public effectively, and how to kind of tell people what they make of this last high inflation episode, what they've learned from it, and what it's going to mean for how they conduct policy going forward.
Got it. Again, the book is Shock Value, Prices and Inflation in American Democracy. Carola, thank you so much for being on Wealth Formula Podcast.
Yeah, thanks for having me.
Be right back. Welcome back to the show, everyone. Hope you enjoyed it. Again, take this information that I had at the beginning of the podcast to heart. Know that if you're a real estate investor, this window of opportunity is really important. It's a very important opportunity to at least know is there. I mean, if you decide you don't want to invest in this market, then that's fine. But you don't want to say you didn't even know the opportunity was there. It's just the reality, right? If I've had times where I would have really have liked to go down and put a bunch of money in something. I mean, I didn't have any money to do it, but at least I knew about it. So I didn't feel like, shoot, I would have put money in there and I should have put money in there, but I didn't. But anyway, hopefully you enjoyed the show. Let me know. Shoot me an email, buck@wealthformula.com. That's it for me this week on Wealth Formula Podcast. Of course, join us for our Wednesday and Friday shows as well. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, Consult your own financial team before making any investment. See you next time.